When was the last time you looked at your profit and loss statement and trusted what it said? Not just saw a number, actually trusted it as an accurate picture of how the practice is running. For most solo coaches, the honest answer is, I'm not sure I know how to tell if I should trust it. That's the gap this unit closes. The bookkeeping discipline a solo practice actually needs, with nothing extra bolted on. A calibration question to start. When was the last time you looked at your profit and loss statement and trusted what it said? Not just saw a number, actually trusted it as an accurate picture of how the business is running. For most solo coaches, the honest answer is, I'm not sure I know how to tell if I should trust it. That's what this video fixes. The without religion framing, what it means. There are tribal wars about bookkeeping software, QuickBooks versus Xero versus spreadsheets, coaches in community groups with strong opinions based on what someone else recommended. The software is not where the value lives. The value lives in closing your books monthly and reading the 4 reports that tell you how the practice is actually running. Pick a defensible tool. Do the monthly work. Everything else is preference. The chart of accounts for a coaching practice, designed for the actual business model. 5 income categories: one-to-one coaching revenue, group and team coaching revenue, training and facilitation revenue, course and digital product revenue, affiliate and referral revenue. 8 expense categories: coaching tools and subscriptions, supervision and peer practice, that's professional development, marketing, contractor and associate costs, legal and accounting, insurance, equipment, professional memberships including ICF. A coaching practice is not a retail business with inventory cycles. The categories are simpler than general small business advice suggests, but only if you design them for the actual business model. The 4 reports that matter, and what decision each one answers. First, profit and loss, trailing 12 months. This is the business model trend. Is revenue direction right? Are expense categories growing faster than revenue? Second, cash flow statement, next 90 days. Can you make payroll to yourself? Cash and profit are not the same number. This report shows the difference. Third, accounts receivable aging, current. Where is money stuck? Which invoices are 30, 60, 90 days overdue? The AR aging tells you before it becomes a relationship conversation. Fourth, quarterly estimated tax liability, due in the next 60 days. What do you owe the IRS this quarter? The answer should never be a surprise. Everything else, dashboards, year-over-year charts, is nice to have. These 4 are the operating minimum. Before and after, the miscellaneous line. A coach with 12 months of mixed category expense tracking. Professional development mixed with marketing mixed with software subscriptions, all as a single miscellaneous line. Question: what did you spend on client acquisition versus professional development versus overhead? Answer: impossible to tell. The spending is a blur. Which lines are earning their keep? No idea. A coach with a clean chart of accounts answers that question in under 5 minutes. The clean system doesn't just organize, it speeds up operator judgment. That's the actual value of bookkeeping. Tool selection at 2 stages. Sub $50,000 revenue, a Google Sheets system with formula discipline, or Simple Practice Lite at $39 per month. Combined bookkeeping cost at this stage, $0 to $39 per month, $50,000 to $100,000. QuickBooks Simple, start at $18 per month, or Zero Starter at $15 per month. Both produce the 4 reports automatically. Above $100,000, QuickBooks or Xero with full accounting integration. The reason to move to software at this stage isn't that the math gets harder. It's that the audit trail needs to be verifiable in ways a spreadsheet can't reliably maintain. Pricing as of 2026. Refresh annually. A note on the Google Sheets path. A well-structured spreadsheet is viable at sub 50,000. It becomes dangerous above 100,000, not because the math fails, but because the audit trail fails. If you're ever audited or need to provide financial records to a lender or investor, the paper trail inside a properly set up accounting tool is cleaner and more defensible than a spreadsheet, even a well-designed one. Make the move before you need to, not after. 2 rules that apply regardless of which tool you choose. 1 clean business bank account, 1 business credit card, 0 personal to business mixing, commingling funds, paying personal expenses from the business account or covering business costs from personal accounts, does 2 things. It invalidates the LLC's liability protection by demonstrating that the business and personal financial lives are not actually separate, and it creates categorization chaos that never resolves cleanly when you're trying to close the books months later. For reference, current pricing on the 2 most common tools for coaching practices. QuickBooks. Simple start, $18 per month as of 2026. Handles all 4 reports, integrates with Stripe, connects to most business bank accounts. Zero starter, $15 per month. The alternative most accountants can read without retraining. Both are defensible at the $50,000 to $100,000 revenue range. The question is which your accountant prefers. That's a relevant input if you're already working with one. The most common bookkeeping failure in solo coaching practices is not a system failure. It's not software failure. It's this. A coach who did the books in October for January through September. By that point, every miscategorized expense is impossible to verify. Receipts are gone. Context is gone. The October reconciliation is a guess dressed as accounting. The fix is 1 rule. Books close by the 10th of the following month. That's the discipline, not the tool. This is on work from Module 0, the operator work that nobody trained you to do, and that doesn't feel like coaching. The Bookkeeping and Quarterly Tax Setup Guide in the lesson resources includes the Chart of Accounts template, the account opening checklist, and a quarterly close calendar with 2026 estimated tax payment dates pre-filled. Run the checklist against your current setup. Every gap is a task with a 1-hour time estimate. Next, the retirement moves that sit on top of this foundation, available only to S-Corp coaches, and almost never explained correctly for self-employed people.